Today, we are going to look at double taxation relief. Double taxation relief is one of the important topics in advanced taxation. So that is what we are looking at today, double taxation relief. We are going to start by looking at what is double taxation. What do you understand by double taxation? Double taxation simply means a situation where income or capital of a taxpayer is being subjected to tax more than once, is being subjected to tax by more than one tax authority in different countries. What this simply means is that in a situation whereby an income is subjected to tax more than once in the hand of different tax authority and in different countries. That is what double taxation means. When an income is subjected to tax in the hand of different tax authority in more than one different countries or in two or more countries, that means is double taxation. Double taxation is different from multiple taxation. Multiple taxation simply means a situation where it is a situation where an income is subjected to tax in the hand of different tiers of government. What multiple taxation means? It means a situation whereby same or similar type of taxes is imposed on an income by different tiers of government. Federal government collects tax on income earned by a taxpayer. State government collects tax, local government collects tax. That one is multiple taxation. What that also simply means is that multiple taxation occur within a country, while double taxation, it involves two or more countries. Multiple taxation occur within a country, but in the case of double taxation, it involves two or more countries, country A and B. But when we talk about multiple taxation, it occurs only in country A. But where an income, let's say a taxpayer earn 500,000, federal government collect tax on it, state government collect tax on it, local government collect tax on it, that is called multiple taxation. But in double taxation, an income is subjected to tax by different tax authority in different countries. So that is double taxation. Now, what are the type of double taxation we have? Basically, there are two types of taxation. Please, let's try to mute our audio. You are distracting our class. Type of multiple taxation. There are two types of multiple taxation. We have juridical type of double taxation, type of double taxation. There are two types of double taxation. Number one is called juridical double taxation, while number two is called economic double taxation. So we have two types of double taxation. juridical double taxation, and what? Economic double taxation. What is juridical double taxation? Juridical double taxation simply means a situation where an income is taxed. A situation where an income is taxed twice in the hand of the same taxpayer. Juridical double taxation simply means a situation where same income is taxed twice in the hand of the same taxpayer from by different tax authority in different countries. Let me give an example of juridical double taxation. A medical doctor traveled to UK to carry out a medical service in one of the UK hospitals. The medical doctor resides in Nigeria. So the income earned from that medical service he rendered in abroad is going to be taxed in abroad. While taking the income to Nigeria too, the income is going to be subjected to tax. That is called juridical double taxation. Economic double taxation. What does economic double taxation mean? Economic double taxation, this one means a situation whereby same income is taxed twice in the hand of two different taxpayers by different tax authority and in different countries. A situation where same income is taxed twice in the hand of two different taxpayers by different tax authority in different countries. That one is called economic double taxation. A company earns an income in abroad. The income has been subjected to tax. When the company distributes the income to one of their shareholders in Nigeria, Nigeria government want to tax the dividend. That one is called economic double taxation.
Sir, sorry,
Now,
please, can you repeat it again? Please, I still don't understand it. Is it that the number is because of the number of people, or
what I'm saying is, a company made a profit of 500 million, and the company has paid tax on the profits. Why the company want to distribute dividend to shareholder? One of the shareholder are in Nigeria. Despite the income has been subjected to tax in abroad, while receiving the dividend in Nigeria, the shareholders too that receive the dividend in Nigeria will pay tax on the dividend. That is economic double taxation. That means that same income is subjected to tax twice in the hand of two different taxpayers. One is company, one is the individual. Second person is the individual that received the income in Nigeria. That is called economic double taxation. So, what do we understand by double taxation agreement? What do we understand by double taxation agreement? What is double taxation agreement? Double taxation agreement is otherwise called tax treaty. Double taxation agreement is otherwise called tax treaty. This means a situation where same income is taxed twice. Double taxation agreement is called tax treaty. It is an agreement between two or more countries for the avoidance of double taxation on income. When two or more countries sign an agreement that they are going to eliminate double taxation on some of the income, that is double taxation agreement. Let me explain it in a layman's shape. When Nigeria and UK sign an agreement, part of the agreement may be if an income is coming from UK and the income has been subjected to tax already in UK, when you take the income to Nigeria, the income should not be subjected to tax again, or the income should be subjected to tax at a reduced rate, at minimum rates in Nigeria. That is double taxation agreement. An agreement between two or more countries for the avoidance of double taxation on income or elimination of double taxation on income. That is called double taxation agreement. It's also called tax treaty. Two or more countries can sign an agreement that if an income has been subjected to tax at the source, when you take the income to the second countries, the income should not be subjected to tax again, or the income should be subjected to tax reduced rates. So that is called double taxation agreement. Objective of double taxation agreement. What are the objectives of double taxation agreement? Why do we go into double taxation agreement? Why does country or Nigeria tax authority go into double taxation agreement with another tax authority in foreign countries? Why does Nigeria government enter into double taxation agreement with another government? So what are the objectives? Number one objective of double taxation agreement is avoidance of double taxation on income. Avoidance of double taxation on income. Number two is grant of tax treaty benefits. Number two objective of double taxation agreement is to grant tax treaty benefits. Number three objective of double taxation agreement, to ensure we are on objective of double taxation agreement. One of the objectives of double taxation agreement is to ensure non-discrimination between taxpayers. To ensure non-discrimination between taxpayers. Another objective is to prevent fiscal evasion and avoidance. That means to prevent tax evasion and avoidance is another objective of double taxation agreement, to prevent tax evasion and avoidance. So it's another objective. So these are the objective of double taxation agreement. Now, let's look at the list of countries that Nigeria signed double taxation agreement with. What are the list of countries that Nigeria signed double taxation agreement with? One of the countries that have double taxation agreement with Nigeria is United Kingdom. We also have France, we have China, we have Canada, we have South Africa, we have Netherlands, we have Romania, we have Spain, we have Italy. All these are the list of countries that Nigeria signed double taxation agreement with. There are more than this, but I just listed few of them. So now let's look at what are the key features or content of double taxation agreement. If two countries sign double taxation agreement together, what are the content of those agreements. When two countries sign double taxation agreement together, what are the content of the agreements? Number one, the name of the two countries. The name of the two countries involved in the agreement. The name of the two countries involved in the agreement must be stated as part of the features or content of double taxation agreement. The name of the two countries involved in the agreement. Number two, the rate of tax applicable in the two countries. The rate of tax applicable in the two countries is part of content of double taxation agreement. The rate of tax applicable in the countries. Another one, the transactions on which double taxation relief is applicable. The transactions on which double taxation relief is applicable is also part of content of double taxation agreement. The transaction that if you carry out the transaction, you are going to be given double taxation relief. This is part of the content of double taxation agreement. The arrangement for the exchange of information between two different tax authorities. The arrangement for the exchange of information between two different tax authorities is also part of content of double taxation agreements. Another content of double taxation agreement is the appeal procedure in the event of disputes. The appeal procedure in the event of what? Of a dispute. This is also part of the content of double taxation agreement. Another one, the availability of diplomatic privilege for the taxpayer. The availability of diplomatic privilege for the taxpayer. Another content, which is the major content of double taxation agreement, the date in which the agreement is going to start, the commencement date of the agreement, and possible termination date of the agreement. This is one of the major content of double taxation agreement. And we have another one. What are the profit that will be exempted? Profit exempted is part of content of double taxation agreement. And the method by which effect of double taxation is going to be eliminated. What method are you going to, the countries are going to use to eliminate double taxation? This is also part of content of double taxation agreements. So we have looked at the features or part of or content of double taxation agreements. We have looked at the features or content of double taxation agreement. Now, let's look at the income exempted from double taxation. What are the incomes exempted from double taxation? What income do you think are exempted from double taxation? Income exempted from double taxation. What are the income exempted from double taxation? Number one income exempted from double taxation. That means if you earn this kind of income, you are not going to pay double tax. That means if you earn this kind of income, once you have paid tax from the source country, you will not pay tax in the destination countries. One of the content of double tax, one of the income exempted from double taxation, one of the income exempted from double taxation is remuneration of a professor or academia who reside outside the country for not more than 2 years for the purpose of teaching. This one is common to those lecturers. Some of them, they will travel out of the country. They will say they are on sabbatical leave. That means during that period of sabbatical leave, when they travel out of the country, they may go and lectures in some foreign university. Once they lecture in some foreign university, if they are paid remuneration salary in those universities, those countries will deduct tax on the remuneration. Why taking the salary to Nigeria? If they stay in that foreign country for not more than 2 years, if they take the income to Nigeria, Nigeria government will not tax the income again. But if they stay in that foreign country for more than 2 years, and while receiving salary during the lecture, during the sabbatical leave, so once they take the income to Nigeria, those income may be subjected to tax because they have stayed outside Nigeria for more than 2 years. Another income exempted from double taxation. This one means government pension, except government pension are exempted from double taxation, except or unless if the recipient is ordinary resident in Nigeria. Government pension, let me explain this. This one means if you are a Nigeria citizen, you travel to abroad and you are employed by the USA Army, you work in the USA, United States of America Army for like 20 years. After 20 years, you resign, you say you are coming back to Nigeria. Since you have worked with them, you have served the US, you have served them very well, they may be paying you pension. Those pensions that they pay you, while paying you the pension, they will deduct tax on the pension. If you take the pension to Nigeria, while receiving the pension in Nigeria, Nigeria government don't need to collect tax again. So this is part of the income exempted from double taxation. Another income or profit exempted from double taxation is aircraft, or shipping profit. Aircraft and shipping profit are 100% exempted from double taxation. Aircraft and shipping profit are 100% exempted from. Why? Because anything airline, shipping company, there is a way we tax them. Under taxation of specialized business, there are some steps that we follow for subjecting a company engaged in airline and shipping activity to tax. So that means their income cannot be subjected to double taxation, since we have a particular provision, which is, I think, section 14 of CETA, stated clearly on how airline and shipping profit will be subjected to tax. So they are exempted from double taxation. Another one, dividend paid by United Kingdom company to a Nigeria resident who has no permanent establishment in United Kingdom. Dividend paid by United Kingdom company to a Nigeria resident who has no permanent establishment in United Kingdom. This one too is exempted from double taxation. Another one, payment to a student or apprentice during his full-time education or training in Nigeria. Payment to a student or apprentice during his or her full-time education or training in Nigeria. This one too is exempted from double taxation. So these are all the income exempted from double taxation. Now, what are the methods of elimination of double taxation? If two countries sign double taxation agreement together, what method can we use to eliminate that double taxation? what method can we use to ensure that the income will not be subjected to double taxation when two countries sign double taxation agreement together? There are two methods of elimination of double taxation. It's either exemption method or credit method. Basically, there are two methods of double taxation: exemption method or credit method. Exemption method simply means the income is totally exempted from double tax. That means once that income has been subjected to tax in abroad, in the foreign country, when you take the income to Nigeria, since the two countries sign an agreement together, the income will be totally exempted from tax in Nigeria. That is exemption method. When you are using exemption method, it will be clearly stated in the content or in the features of the double taxation agreement. So somebody raise hand. What is your question?
You said types of double taxation, and we've done the types. So how is this different?
This one, I did not say type of double taxation. I said method of what?
Okay.
Method of elimination of double taxation. This one, some people can call it type of double taxation relief. Method of elimination of double taxation is the same thing as type of double taxation relief. Number one is exemption method. Number two, credit method. Credit method simply means when the income has been subjected to tax outside the country, in the foreign country, while taking the income to the home country, which is Nigeria, the income too will be subjected to tax in Nigeria, but it's going to be subjected to tax at a reduced rate. That means credit will be given to the foreign tax suffered, assuming when the income is subjected to tax in the foreign country, they pay a tax of 5,000 naira. And the income want to be subjected to tax in Nigeria, and we computed the tax of 7,000 naira in Nigeria. Instead of paying the tax of 7,000 naira, the tax authority can say, since you have paid 5,000 naira in abroad, we are going to give you a discount. Instead of you paying 7,000 in Nigeria, come and pay 4,000 in Nigeria. That 3,000 discount given to you is a credit. It's a credit. It's a credit method. That is the credit. So that is that. Another area we should look at when talking about double taxation agreement, when there is conflict between two countries that sign double taxation agreement together. Take for instance, when Nigeria signed double taxation agreement with another countries, and there's a conflict in that double taxation agreement. How do we resolve the conflict? What are the resolution of the conflict between double taxation agreements? Number one is when a resident of the contract state consider that the action of one or both of the contracting states will result from him in taxation not in accordance with the agreement, with the competence of the contracting state of which is he is resident. So what this one means is that when there is a confliction between state of residence between two countries as to which taxpayer, where the taxpayer reside. So we need to know, in that case, the competent authority which is the tax authority, will determine which state is the taxpayer residing. So the states that the taxpayer resides in the previous year, that is where the taxpayer will pay his tax. Second one, when there is an objection.
In this first one, sorry.
When there is an objection, please, when you have to ask a question, you can raise hand, you can signify. So what this one is saying is, when there is a number one, when there is a dispute between state of residence, maybe there is a confliction between, there is no clear guideline. Take for instance, the taxpayer is residing in two different countries, and the two different countries, they have double taxation agreement together, and there is now a conflict that which one is the source country, which one is the destination country. The destination country is saying that is the one that will collect the tax, while the source country have already deduct the tax. And two of them are claiming that the taxpayer are the resident of their countries. So what do we do is that we need to know in the last year of assessment, where does the taxpayer reside? Where the taxpayer resides in the last year of assessment, which is the preceding year of assessment, that is where we are going to assume the taxpayer is resident in this current year of assessment. That is what that number one is saying. So number two is saying that when there is an objection, the competent authority shall endeavor that if the objection appear to be justified. What is objection? If the taxpayer objects any of the tax assessed to the taxpayer, and the objection, the tax authority must ensure that the objection is resolved between the two countries based on what is called mutual agreement. In some textbook, you will see it called mutual agreement procedure. What does mutual agreement procedure mean? Based on the guideline stated in the content of double taxation agreement, if any of the taxpayer object the assessment, imposed on him by the tax authority, the way that assessment objection can be resolved is going to be based on mutual agreement procedure. This mutual agreement procedure has been stated in the content of double taxation agreement as part of the those steps that we need to follow when you have conflict between two taxpayers. So that is part of the resolution conflicts. When there is conflict on double taxation agreement, that is part of the resolution conflict. So now let's try to look at, for the sake of time, let's talk about double taxation relief. What is double taxation relief? What do we understand by double taxation relief? And how do we compute double taxation relief? Double taxation relief simply means an allowance or credit available to an income that have suffered tax outside the country or outside Nigeria. Double taxation relief. Is an allowance or credit available to an income that have suffered tax outside the country or outside Nigeria. What this means, when two countries sign an agreement together and they have agreed that if the income has been subjected to tax in the source country, while taking the income to the destination country, the income should be subjected to tax at a credit rate, at a reduced rate, or at minimum rate. That credit or allowance given to the taxpayer on those income that have suffered tax outside Nigeria is called double taxation relief. Let me give an example. When an income has suffered tax of 10,000 naira outside Nigeria, you now take the income to Nigeria. Nigeria government impose 17,000 tax on the income again. Because Nigeria government has an agreement with the foreign countries, they now said, the 10,000 naira you pay outside Nigeria, we are going to give you discount of 50% on it. That means the 10,000 you pay outside Nigeria, we are going to give you a relief on it. That 10,000 you pay outside Nigeria, we are going to give you a discount of 5,000. That 5,000 discount given to you, you are going to use it to reduce your Nigeria tax. You know you want to pay 17,000 naira in Nigeria. You now minus 5,000 naira from 17,000. That means the net tax you are paying in Nigeria is going to be 12,000. The net tax you will be paying in Nigeria will be 12,000. Double taxation relief is an allowance or credit available to an income that have suffered tax outside the country or outside Nigeria. That is double taxation relief. When we are talking about method of elimination of double taxation, we talk about exemption method, we talk about credit method. That credit method, we make use of that credit method through the use of double taxation relief. That credit method, we make use of it through the use of double taxation relief. Now, we have looked at double taxation relief. Now, how do we compute double taxation relief? Computation of double taxation relief. We want to look at how we compute double taxation relief. First, we are going to look at how we compute double taxation relief for a resident companies. First, we are going to look at how we compute double taxation relief for what? For a resident companies. What is a resident company or Nigeria company? What do we understand by a resident company or Nigeria companies? Resident company simply means a company that is incorporated or registered in Nigeria. Any company that is incorporated or registered in Nigeria under Corporate Affairs Commission, that company is called a resident company or Nigeria company. And we should have it in mind. Resident company, they are access to tax on their worldwide income. Resident company are access to tax on their what? Worldwide income. They are liable to tax on their worldwide income. What is worldwide income? That means the income that they receive in Nigeria and the income that they receive outside Nigeria. Let me repeat again. Resident company is liable to tax in Nigeria based on their worldwide income or profit. That means the income that they receive in Nigeria and the income that they receive outside Nigeria. Resident company may have a branch outside Nigeria and their head office is in Nigeria. What that one means is that if a resident company want to be liable to tax in Nigeria, they are going to be liable to tax based on the profit of their head office in Nigeria plus the profit of their branch outside Nigeria. But while assessing the profit of their branch outside Nigeria to tax, you must give that profit some double taxation relief, some double taxation allowance. Now, what are the methods for computing double taxation relief for resident company or a Nigeria company? One of the methods of computing double taxation relief for resident company or Nigeria company, we must have it that first, when there is no agreement between the two countries involved, we are going to make use of Commonwealth rate. We are going to compare Commonwealth rate with Nigeria tax rate. When we compare the two, the lower between the two is what we are going to use as our double taxation relief rate. But when the two countries involved sign double taxation agreement and the double taxation relief rate is going to be the rate stated in the agreement. Let me repeat myself again. What are the methods for computing double taxation relief for a resident company, meaning Nigeria company? First, you must have it in mind that if the two countries involved sign double taxation agreements, the double taxation relief rate is going to be the rate stated in the agreement. However, when there is no agreement between the two countries, there is no double taxation agreement between the two countries. That means we are going to find Commonwealth rate. How do we compute Commonwealth rate? Foreign tax paid all over total profit of the foreign business times 100. That is your Commonwealth rate. Foreign tax paid all over total profit from foreign business times 100. That is your Commonwealth rate. Once you get your Commonwealth rate, you are going to compare your Commonwealth rate with Nigeria tax rate. We know company tax rate for Nigeria as at present, the company income tax rate for Nigeria as at present is either 20% or 30%. It depends on the turnover. So, once you get your Commonwealth rate, you compare it with Nigeria tax rate. When your Commonwealth rate is higher than Nigeria tax rate, that means the double taxation relief that will be given is going to be what? Half of Nigeria tax rate. Anytime Commonwealth rate is greater than half of Nigeria tax rate, the double taxation relief shall be half of Nigeria tax rate. But when Commonwealth rate is less than half of Nigeria tax rate, that means the double taxation relief is going to be Commonwealth rate. When Commonwealth rate is less than half of Nigeria tax rate, that means the double taxation relief is going to be Commonwealth rate. That is for resident company, meaning Nigeria company. That is resident company, meaning Nigeria company. Now, we are still on method of computing double taxation relief. We have looked at the one of resident company. Let's look at the one of non-resident company. Let's look at the one of non-resident company. What is in Nigeria? What is a non-resident company? A non-resident company also means non-Nigeria company. A non-resident company also means non-Nigeria company. Any company that is not registered or incorporated in Nigeria, but they derive profit or income from Nigeria, that means that company is a non-resident company. A company is not registered or incorporated in Nigeria, but they are deriving profit in Nigeria. That company is a non-resident company. However, non-resident company, they are liable to tax only on the profit derived. They are liable to tax in Nigeria. Non-resident company are liable to tax in Nigeria only on the profit derived from Nigeria environment. Only on the profit derived from Nigeria. That means they are not liable to tax on the profit that they derive outside Nigeria because they are non-resident company. They are liable to tax only on the profit derived in Nigeria. How do we compute double taxation relief for a non-resident company? When we want to compute double taxation relief for non-resident company, we compare Commonwealth rates with Nigeria tax rates. If Commonwealth rate is greater than Nigeria tax rate, if Commonwealth rate is less than Nigeria tax rate, our double taxation relief is going to be half of Commonwealth rate. But when Commonwealth rate is greater than Nigeria tax rate, double taxation relief is going to be Nigeria tax rate minus half of Commonwealth rate. When Commonwealth rate is greater than Nigeria tax rate, double taxation relief under non-resident company is going to be what? Nigeria tax rate minus half of Commonwealth rate. That is it for non-resident company. Number three, that we want to look at now on method of computation of double taxation relief, on how we compute double taxation relief. We have looked at how we compute double taxation relief for resident company. We have looked at how we compute double taxation relief for non-resident company. The third one now is we want to look at how we compute double taxation relief for resident and non-resident individual. How we compute double taxation relief for resident and non-resident individual. A resident individual means Nigeria residents. Resident individual is also called Nigeria resident. Who is a resident individual? A resident individual simply means a person that domicile in Nigeria. for more than 183 days. A resident individual means an individual or a person that reside or domicile in Nigeria for more than what? 183 days. And secondly, a foreign citizen. Secondly, a Nigerian citizen serving as a diplomat in a foreign country. When you want to define resident individual, we said they are the persons or individual that domicile in Nigeria for more than what? For more than 183 days. And a Nigerian citizen serving as a diplomat in a foreign country. What this one means is that under the tax law, for you to say you are a Nigerian resident, that means you will have stayed in Nigeria in a relevant year of assessment for more than 183 days. Under the tax law, if you want to say somebody is Nigerian resident, we will not look at whether the person is born in Nigeria or his parents is from Nigeria. No. The basis that we are going to use to consider you as a Nigerian resident is in a particular year when you stay in Nigeria for more than 183 days, which is half of a year. That means automatically you are a Nigerian resident. Non-resident individual. Who is a non-resident individual? A person who does not domicile in Nigeria for more than 183 days, but derive income or profit from Nigeria, they are non-resident individual. Also, a foreign citizen serving as a diplomat in Nigeria, a non-Nigeria resident, which is non-resident individual, is a person or individual that does not domicile in Nigeria for more than 183 days. He does not stay in Nigeria for more than 183 days in a relevant year of assessment, but derive income or profit from Nigeria. And a foreign citizen serving as a diplomat in Nigeria. These are what? Non-resident individual. What are the method of computing double taxation relief for non-resident individual? What method do we use to compute double taxation relief for both Nigeria residents, both resident individual and non-resident individual? Two of them together is the same method. Both resident individual and non-resident individual. What method do we use to compute double taxation relief for them? We compare Nigeria tax rate with Commonwealth rates. We compare Nigeria tax rate with Commonwealth rate. Higher of either Nigeria tax, lower of either Nigeria tax rate or Commonwealth rate. Under resident individual and non-resident individual, the Commonwealth rate means foreign tax paid all over gross foreign income. Foreign tax paid all over gross foreign income. Foreign tax paid all over gross foreign income times 100 over 1. That is how we compute Commonwealth rate under both resident individual and non-resident individual. That is how we compute Commonwealth rates. Now, question 1. Let's look at question. So let's look at some questions on this double taxation relief. Before we go to question 1, I would love us to look at question. Go ahead, ask your question.
Sir, please, I just want to clarify that for for resident and non-resident individual, when computing double taxation, we are just checking for which one is lower between Nigerian tax rates and Commonwealth rates. We are not doing any times half of
No.
Commonwealth.
We are not doing that. We are not doing that.
Okay,
We
sir.
are not doing that. We compare the lower. Do we understand?
Yes,
You
sir.
are right. We compare the lower. Question 4. Let's look at question 4. Someone, this you help us read the question 4.
A Nigerian company, Midas Touch Nigeria PLC, is a manufacturer of cornflakes highly consumed by the children. The company has been operating in Nigeria for some years with an agency in UK where its products are highly patronized. The trading results, which were based on the business operations in Nigeria and UK for the year ended 30th September 2023, revealed the following. Go down. This following is more true. All figures assume correct. Turnover, other income, total income, cost of sales, gross profits, expenses, donation to clubs, rent, consultancy services, loss incurred in 2015 financial year, depreciation, allowance for bad debt, entertainment and traveling expenses, property rates, tariffs, duties, foreign exchange loss provision, sales commission, repairs and maintenance, miscellaneous expenses, total expenses, then we have the total profit. Other information include 1. The capital allowance for the year as agreed with the Inland Revenue were for Nigeria and UK, all figures as incorrect, initial and annual. Number 2, the company had paid to the UK tax authority the sum of 1,150,000 naira as tax on income derived from the UK. Number 3, foreign exchange loss provision arose as a result of fluctuation in converted cash balance in pound sterling in a bank in the UK. Required, compute the tax liability of the company on the total profits for the tax year, bearing in mind the double tax relief. Solution.
Okay. Thank you. Now, how do we know that this is a double taxation relief question? This company, which type of company is this company? This company is a what?
Manufacturing company.
Manufacturer.
No.
Manufacturing.
You know, in my
A company
explanation under
abroad.
the method of computation of double taxation, I said I look at resident company, I look at non-resident company, I look at resident individual and non-resident individual. So those 3 aspects that I talk about, which one this one fall into?
Resident company.
It's a resident company. That means this company is incorporated in Nigeria. They are registered and incorporated in Nigeria. And we know that they are going to be assessed to tax in Nigeria based on what their worldwide income. That means the income that they receive in Nigeria plus the income that they receive in foreign country. When they want to test double taxation relief, they will say this company, this Nigeria company, they have a branch in another countries, not subsidiary. They have what? A branch. Under double taxation relief, branch is different from subsidiary. This company has a branch in another country. The profit of the branch in another country has been subjected to tax in the foreign countries. While taking the profit to Nigeria too, the profit will be subjected to tax in Nigeria. But before the profit will be subjected to tax in Nigeria, we have to give them what kind of relief? We have to give them double what? Double taxation relief. So this Midas Touch is a manufacturing company. They have been in Nigeria operating with agency in UK. That means they have a branch in UK. So the profit of the branch in UK, since it's between head office and branch, the head office is in Nigeria, the branch is in UK. The relationship is between head office and branch. Double taxation relief will be applicable. But a relationship between parent and subsidiary, double taxation relief will not be applicable. When they say a company in Nigeria, a Nigeria company has a subsidiary in abroad, double taxation relief will not be applicable. So ask your question. Go ahead.
So I wanted to ask that what of issues about um people are being related, like transactions not happening at arm's length. Is that one not considered in this head office and branch transaction?
When transaction is not done as arm's length, we are going to look at the fair value. If we are told when there is transaction between the head office and this one stating that head office is a business entity on its own, the branch too has its own business, selling goods, incurring expenses. They are not saying the one you are talking about when we are talking of arm's length transaction is when there is transfer pricing. That means if head office sell good to branch, that is when we are going to be talking of arm's length transaction fair value. This one is talking about the head office in Nigeria make its own profit. The branch in foreign country too make its own profit. The profit of the branch has been subjected to tax in the foreign country. And Nigeria authority too want to subject the profit of the branch to tax in Nigeria. While subjecting the profit of the branch to tax in Nigeria, we are going to give them some double taxation relief. That is what we are saying here. So arm's length transaction or interrelated this one does not applicable here. There is a topic, is still under international tax. It is called transfer pricing policy. That is transfer pricing regulation. That is when we are talking of arm's length transaction, fair value, and so on like that. Hope your question is answered.
Yes, thank you, sir.
Okay. Now, looking at this, we need to first, we are asked to compute the tax liability. We want to compute the tax liability. How do we compute the tax liability? First, we start with net profits. What are the net profits? The net profits for the UK and Nigeria. For UK, its own net profit is 3,082,000. While from Nigeria, the net profit is 5,214,000. The total net profit is what? 8,296,000. 8,296,000. From the net profit, you add back disallowable expenses. So let me open a spreadsheet for solution so that we can understand. Let me open a spreadsheet. The name of the company is called Midas Touch. The name of the company is called Midas Touch. So while computing the profit, you need to look at both the Nigeria and UK. You also need to look for the total. We have UK, we have Nigeria, the net profits, net profits for the UK. How much is the net profit? You want to ask a question, go ahead and ask your question.
Yeah, so your Excel sheet is not showing. It's only the
It's not showing.
word.
Okay.
It's only the word.
Let me share it. Sorry. Okay. Can you see it now?
Yes,
Is it
sir.
showing now?
Yes,
okay.
sir.
So now, the net profit is how much for the UK?
3,082,000.
3,082,000. Why for Nigeria?
5,214,000.
Add
Salary.
disallowable expenses. Add what? Disallowable expenses. What are the disallowable expenses here? Let's go back to the expenses side in the question. What are the disallowable expenses? Can we all see the question?
Yes, sir.
Okay. I want to share the question again. Let's highlight the disallowable expenses. Number one expenses in this question is what? Check the
Donation
expenses.
to club.
Donation to club.
Donation to club.
Yeah. Is it allowed or disallowed?
Disallow.
Disallowed.
Yeah, let me highlight them. I will still take them to the Excel sheet too, but I want to highlight this. I want to just color the disallowable expenses first in the question. Rent, is it allowed or disallowed?
Allow.
Consultancy fee, consultancy service, allow.
Allowed.
Allowed.
Yes.
Loss incurred in 2015 financial year. They incur a loss. They are now adding it as an expenses. Allow or disallow?
Disallow.
Disallow. Why do you incur a loss? You are now hiding. You are now putting it as part of your expenses. Depreciation cost.
Disallowed.
Oh yeah.
We are wrong.
Allowance for bad debt.
Allowed.
Allowance for bad debt. It means provision for bad debt.
General
Allow,
disallowed, specific allowed.
We are going to assume it's general. We disallow it.
Disallowed.
Entertainment and traveling expenses, we allow that. Property rate, tariff, duties, we allow that.
Okay.
Foreign
Allowed.
exchange loss provision. Foreign
Disallow.
exchange loss provision. What do we do?
Disallow.
Disallowed.
Anything foreign exchange loss provision. Provision for foreign exchange loss is disallowed. But realized foreign exchange loss is allowed.
Sir, I thought
Which
that
other
tax
one?
rates would not be
Commission.
allowed.
Allowed.
Sir, I thought that
Property rates, tariff, and duties.
yes, they will be disallowed
It's allowed.
because
It's allowed.
okay.
Rates, when you pay tournament rates, all those kind of things, it is allowed.
Tariff or duties. It's allowed.
Yes. Sales commission.
It's allowed.
Allowed.
Repair and maintenance.
Allowed.
Miscellaneous expenses, they are
Based
all
on the
allowed. So that
contents.
means
Allowed.
all the disallowable expenses we have in this question, donation, loss on loss incurred on this, depreciation, and so on like that. So those are the ones we have. So we need to just go and take them and put them under the disallowable expenses. We need to just take them and take them to our disallowable expenses.
So,
Oh no.
just so that if not that, I have to tell her.
Please try to mute your audio. You are distracting us. So if you look at the disallowable expenses, look at my disallowable expenses, donation, profit on sale, donation, depreciation, and so on like that. You can see them. All the ones we highlighted, they are all classified under disallowable expenses. When you add your disallowable expenses, under your question, we are not told whether the income is non-taxable income, whether the other income, we're not told whether it's a non-taxable income. So what we need to do after this is to get our adjusted profits. You need to get your adjusted profits. You add the net profit plus the disallowable expenses. You add the net profit plus the disallowable what? Expenses. You add it. So your adjusted profits. The adjusted profit for UK, 5,847,000. While for Nigeria, 8,414,000. While for the total, 14,271,000. After adjusted profit, what do I minus? After adjusted profit, what am I going to minus?
Capital allowance and relief.
Capital allowance. In this question, do we have capital allowance? Do we have capital allowance in this question? Check.
Yes.
Oh yeah, what are the capital allowance? Oh
Initial
yeah, now.
520,000. For UK,
In,
520,000.
for UK,
520,000.
okay.
It's for Nigeria. It's for Nigeria. Oh.
Sorry. No, UK. Okay, sorry, Nigeria.
The examiner deliberately put it like that. Oh yeah, for UK, annual allowance. How much is annual allowance for UK?
Maybe 75.
375.
You put that first. Why for Nigeria?
250.
Initial allowance,
No.
20.
520.
520.
Mm.
Annual allowance.
250.
50.
Abi?
Yes.
Yes.
That means your total profit. Total profit simply means your adjusted profit minus your capital allowance. Do we understand? Do we understand?
Yes, sir. I do understand.
So once you are getting your total profit, you will compute your tax
Please.
liability. First type of tax this company will pay is called what? Company income tax. What is the rate of company income tax am I going to use? You will go back to your question. When you add the two turnover together for the two companies, their
Give us
turnover is how much?
40 million.
40 million.
40 million.
That means I'm going to use rate of what? 20%, since the turnover is no more than 100 million.
Mm.
Do you understand?
Yes, sir.
Since the turnover is no more than 100 million, I will say 20% times the total. That means times 20% of this. That is your CIT. That is the company income tax this company is supposed to pay. We will now say from this company income tax, let's double tax relief. Let's what? Double tax relief. How do I get double tax relief? I will go to a working note. Working notes. Working notes. Working notes. For my working notes, I will set computation of DTR. DTR means double tax relief. How do I compute double tax relief for a resident company? I will first of all go get my common wealth rate. If I want to get the common wealth rate, what is the formula for getting common wealth rate for a resident company?
Foreign tax paid over total profit of foreign business times 100.
How much is the foreign tax paid? How much was paid to the foreign tax authority in the question? How much was paid to the total foreign tax authority? Go to the question and check. How much was paid to the foreign tax authority? Check the question now.
Sir, 1,150,000.
Can we see that?
Yes,
Yes,
sir.
sir.
Yes.
$1,150,000 was paid to the foreign tax authority. $1,150,000. Abi, this was paid to the foreign tax authority. What is the foreign total profit? Foreign total profit.
$7.6 million.
7,644,000.
Foreign total profit. Profit of the foreign business. Foreign business.
Okay.
Which one is foreign?
5 million.
5,470,000.
You ask yourself, which income, which profit want to suffer double tax? Look at the question. Look at the solution. Out of UK and Nigeria profit, which one wants to suffer double tax? Which one have suffered tax outside Nigeria before?
UK.
The
UK. It is the one that have suffered tax outside Nigeria. So just take it. When you divide, so what is your answer? This divided by this. %21.02%. 21.02%. That is, you compare it with what? What do you compare it with? Half of
Half of Nigerian tax rate.
Nigeria tax rates. How much is half of Nigeria tax rates? The Nigeria tax rate in this question we use. What is the Nigeria tax rate we use?
20%.
The company income tax rate that we use is 20%. Half of company income tax rate. Half of 20% will give us what?
10%.
10%. 10%. So that means my double tax relief rate, which one am I going to take?
You take the Nigerian tax rate. Half of the Nigerian
I
tax rate.
take the lower one. I will take the lower one. Since half of Nigeria tax rate is less than Commonwealth rate, I will take the half of Nigeria tax rate. So my double tax relief is going to be 10%, which is half of Nigeria tax rate. 10% of what? You now ask yourself, which income want to suffer double tax? Which total profit want to suffer double tax?
Okay.
5 million.
10% of 5,472,000. So you minus it. You minus it from the CIT. minus it from the CIT. Once you minus it, that means your net CIT, your net company income tax is going to be how much?
2,076,000.
2,072,000. You can now compute another type of tax called TET, education tax. What rate is that? As our 2024 year of assessment, 3%. 3% of what? On what rate do we compute TET? On what profit?
Nigeria.
On adjusted profit, the total adjusted profit. We compute TET on adjusted profit, total adjusted profit. So this is the tax you will pay. Do we have any question here? Do we have any question regarding to this? Do we have any question? So in the absence of no question on this, so by God's grace, our next lecture, we are going to solve 2 more questions on double taxation relief, and we move to 1 international tax. So maybe by tomorrow, I don't know if they are going to fit some lecture tomorrow. So if time permits us, we can finish the double taxation relief. Do we have any question?
No.
So let's try, by God's grace, by tomorrow, if there's any free period, we can arrange for that. So, and we finish the double taxation relief. We still need to solve 2 more questions for better understanding. So if I said I should continue, I'll just solve 1 more question and close the chapter, which to me, let me solve 2 more questions on double taxation relief so that we can know it better. It's one of the important topics in advanced tax, and the question normally come out often and often on double taxation relief. So have a nice day. So let's just stop here. Thank you very much.
Sir,
Yes.
please, let me just quickly ask off-topic question. Is the president exempted from tax?
Is a president exempted from tax?
Yes.
No. President is not exempted from tax.
Okay, so is that a new tax law, or it has always been like that?
It has always been like that. President is not exempted from tax. They pay tax. Yes.
Okay.
Pay tax on their salaries, not on their allowance, on their salaries.
Payee? You mean payee?
Yes, they pay personal income tax.
Okay.
Okay.
Sir, please, can we get this note? This exhaustion.
Okay.
Excuse me, sir, Mr. Idris. Good evening, sir.
Yes.
Please,
I can hear you.
Please, I need a favor from you. Please, there's a class we taught on tradition of specialized business. I've looked for the lecture notes and the calculation on the group. I can't find it. I don't know if you can re-forward, please.
Tradition of specialized business on which area?
And I think all of them, I can't find it.
Okay,
because
all of
I
them.
think I lost it.
Please,
Yes.
my other colleague, if you have the solution of that tradition of specialized business, I think I sent the solution of all the specialized business. I sent a lecture note that has solution. Let me forward it now. For those who are just joining, let's be our brothers EPA. Let's help our brothers. So please, Emily, forward it.
Thank you.
I think
Thank
you have
Thank you.
asked me by sending me direct message.
Yes.
Yes, so I'm
I've
sorry.
asked.
I'm always busy
I
with
understand.
work, busy with so please, I'm sorry. So, but
It's
for
so
those
everywhere,
who
so I
are
understand,
just
sir.
yes, so please, Emily, send it to him. The solution is in the group chat, but you are just joining. That is the reason why you don't have it. So Emily, send it. Me too. I will do that once I finish the class. So the second person asked that this Excel sheet. I'm going to share it. I'm going to share it definitely. I'm going to share it. So even in there is a particular material that have solution to the question on the taxation of double taxation relief, which I can share this night for us. Do we prefer that?
Yes, sir.
Both of them are
Okay, I
good.
will do that. Thank you very much.
Yes, sir.